Welcome to the Market Huddle Plus. I'm Patrick Sresna. This week, we welcome to the show Steve Sosnick from Interactive Brokers. I'm going to chat with him on Nvidia, the markets, and market makers, and so much more. Steve, great to have you back on the show, buddy.
Great to be back with you, Patrick.
Yeah.
Glad to see you're someplace much warmer than I am right now.
Absolutely. All right. Listen, I want to keep this one tight, so we got to dive right into this now. The markets are moving. We have yesterday we had a big update on the markets. Today, Nvidia came with their product launch. A big reversal caused the whole market to sell off. Is Nvidia that important in your mind to what direction the market goes? Like, what's your take on this Nvidia move and how it plays a role in the bigger market trend?
Well, I think sometime early last year I wrote a piece called "It's Nvidia's market. We're all just trading in it," and I think that still holds to some extent. Um, it, it's generally been the most active stock both in the world and on our platform. Although lately Tesla's gotten back to the top slot, which was sort of the perennial number one for the prior years, prior to the AI
Yeah.
enthusiasm. But when I look at it today, and we're taping this Tuesday afternoon, and the markets are tanking a bit, but we're really back to where we were sometime Friday.
Yeah.
And it just shows you how much the markets move, how much, we're starting to see volatility creep back in. And for the last 2 days, we had what I like to call socially acceptable volatility, which is the market went up and everybody was happy because markets are supposed to go up. And the more they go up, generally, the happier people are. When we give back those gains, that's plain old volatility, despite the fact that mathematically they're exactly the same. Volatility is agnostic of the move, but people aren't. Which is why you see, VIX and option implied volatilities go up when markets go down. But reality was, I put out a piece yesterday saying I think this Nvidia thing is shaping up to be a sell the news event, and it wasn't because of any great knowledge I had about what Jensen Huang might say. Literally zero. But you had Nvidia and Tesla both up 10% in 2 days.
Right.
And you got to step back and think, is this completely normal for multi-trillion dollar stocks to just move 10% at a clip? So you had
Yeah.
Nvidia adding roughly $370 billion in market cap in 2 days based on what Jensen Huang might say. And so while what he said seems to be pretty consequential, it wasn't necessarily $370 billion consequential. And that's, I think, where we're getting into with one of the characteristics of the market right now is I think people are very they don't want to miss a rally. FOMO is still out there. And so I think when you get rallies, people pile on them. It's exception. It's exceedingly easier to do on a Friday when you have weekly options on call it your 600 best names, all of which have expiring strikes and all of which could really push a rally higher. And I
Right.
think that's what happened on Friday. I think it continued a bit yesterday, and this is the reaction when you go too far in one direction. We often have a reaction that's not as pleasant.
Okay, well, let's stay on this topic because I want to talk a little bit about indexing and passive investment because obviously this is a dynamic that has actually continued to feed these mega market cap names. Is that as they grow bigger and become bigger percentage of the index, as everyone dumps into the passive investing, a bigger and bigger part of that pie continues to feed these large market cap names. And this has created an amazing dynamic where if you look at something like the equal weight S&P 500, it's been selling off for over a month. And yet when these Mag 7 stocks have been ripping higher, the Nvidias and all the Teslas they're keeping the market cap weighted index up along the highs. And now this has created a dispersion where there was a point where the S&P 500 was still above its 50-day moving average. And at the same time, the breadth of the market based on a metric like a 50-day moving average, 80% of stocks were by that metric in a downtrend. And so you had this idea where there's this big sell-off happening in the majority of stocks. So if you're an individual stock picker and you're putting a basket of stocks together that is diversified, you're like, why the hell am I not matching the index? Why am I not performing the same? Like this dynamic has become the reality of the market. Now, what's your take on this? And do you think that this, how does it play out in the end? Is it just that this keeps compounding further and further, or is there going to be a period where things will kind of revert and come back into balance?
Well, it's understandable why this phenomenon's occurring. Quite frankly, the biggest technology stocks, are showing the most earnings growth, the most market power, and then there becomes a feedback effect. Why should I go out there? I'm talking, facetiously here, but why should I go out there and bother to pick stocks, look for situations when I can just buy, put it all in an S&P index fund, or or even better, put it all in QQQ or an NDX fund,
Yeah.
and just have it perform for me. So that's a positive feedback loop, and because it happens because it's happening. And the problem, the fear I have is that if and when it reverses, it's sort of everybody trying to stampede out of a very crowded exit, because we're so piled into these names. If everybody's long them, who's to buy them if they decline? And I'm not talking about the buy the dip traders. I'm talking about the fundamental
Yeah.
investors who are also quite long. So it, it's one of these things. I called it stock market Jenga last summer, and but quite frankly, the game of Jenga is persisting, and it's one of these. It's less stable. It doesn't seem right, but
Yeah.
as with a lot of fundamental measures, um, fundamental measures aren't necessarily great timing measures.
Yeah.
So we see this going on, but it's tough to say when. We know the valuations are extraordinary, but it's tough to say when that becomes a problem. I mean, December was particularly odd because I think, and I don't have the numbers in front of me, but I think we didn't have our first day where advancers in the S&P 500 led decliners until like the 23rd or something like that. We
No.
basically went 3 weeks with more decliners than advancers in the S&P 500, but it didn't matter because the stocks that needed to go up went up. And again, I didn't update the graph at the end of the year. I was too busy just sliding down that dinosaur tail at New Year's Eve. But I think basically you had the Nasdaq NDX outperforming the S&P 500 by, I think it's like 3 or 4, maybe 5 percentage points, and then S&P 500 outperforming the equal weighted by about 4 or 5 percentage points on the month. Those are some
Right.
dispersions, and that goes right into what you're alluding to. Problem is, if everybody rushes for the exits in the big cap tech stocks, you get you get a day like today, and you could get a period like this that could extend.
Now, do you, that leads into the next question, which is perfectly, which is, okay, so we had this year-end dynamic, which obviously has tax loss selling, window dressing, all sorts of different things that were in play. Obviously, in many cases, after we had, okay, from October of 2023 to December, were up 50% on the S&P in like that 14-month window. It's just an extraordinary run. So people that are holding on to all these capital gains, often there's a logical thought process that they would wait until the next tax year to potentially begin any profit taking. There's no point in selling it out in December. Do you think this is in play? Like, do you feel that this could influence the first quarter of the year and how things play here at the start?
Think there were a couple of factors in play. I think tax law selling was relatively minor because, quite frankly, so
There's
many
nothing.
stocks did so well, there weren't a lot of losses
Yeah.
to garner. So I do think, though, that caused some deferment of the of capital gains, particularly with the new administration coming in. There's people who are hopeful that the capital gains rate may go down, so they're probably holding out a little bit um, about selling, even though the calendar is turned. But what happened then? I think the reason we went into the we saw the mega caps rally so much, at least in the first part of the month, and at various points, was window dressing. If you're a big portfolio manager, you wanted to look like you would be invested in the things that were working, right? I mean,
Yeah.
it was Nvidia. There was plenty of other stocks, but these were the stocks that were working, and so you had that loop. On the other hand, you did have a lot of you had some days in there. The Santa Claus rally proved to be negative. I think it was 5 out of the 7 days that are supposedly part of it were down days. And the reason for that, I believe, and I don't have the firsthand evidence because I don't talk to these accounts. I haven't talked to them for years since that's not our bread and butter. Um, but I do believe there was asset allocation going on. And the way I say this is if I'm a pension fund, and pension funds don't pay taxes, so they don't have to worry about their tax considerations. And my mandate is to be some percentage stocks, some percentage bonds. Let's say, for
Yeah.
argument's sake, 60-40. Well, bond yields were ripping higher, meaning bond prices were going lower.
Yeah.
Well, and stock prices were rallying. So my 60-40 might have been 65-35. And all of a sudden, I want to get back on sides for year end to show a 60-40 portfolio. What am I going to do? I'm going to have to sell some stocks and buy some bonds. And it was interesting because the first relatively large sell off day, bonds didn't really move. But then the second one, but then, and from thereafter, bond prices did show a little bit of a rally. And that's because the pension fund managers, T plus one, they could put the money into the bond market the next day,
Right.
the next trading. I think it was Friday over Monday. And so I do think that was a dynamic going on. And it wouldn't surprise me. I mean, one of the, this does go on, and I think we focus on the day to day. We don't necessarily think about these, these big portfolio, these big pension funds, these huge fund complexes. But they're like steering an aircraft carrier, so it's
Yeah.
not easy for them to do, especially if they're trying to do it into a relatively thin year end. And I think that's kind of how we. I think that's why we saw the run up that we did, and then sort of the lackluster end to the year.
Right. So, and what's interesting, it was that there was another dynamic going into the end of the year, and I wanted with J.P. Morgan Whale having that big options collar open and the gamma influence, and I thought it was a great opportunity for us to talk or take a little deeper dive into the influences that dealers have on the market. So, the options market has been exponentially growing in the throughout the decade. I think 10 billion contracts traded last year, something like 50 million contracts a day. I don't know if those are the right stats. You can correct me if I'm wrong, but
Yeah.
the but you have it where these dealers end up with very large amounts of inventory on their books. And in the case of this JP Morgan whale, there was some 40 some odd thousand contracts, some $25 billion of notional exposure open at the S&P strike at 6,055. Now, I don't want to get into the details of the strategy itself. I want to put it in, talk about it from the perspective of a market maker and a dealer on the other side, something that you've been in the past. Now, you've taken on this responsibility and you're trying to manage your risk by staying delta neutral on your positioning. But now, when you're talking about these kind of huge size trades in the market, it's no longer, in my mind, a game of fundamentals, but now flows matter. Like when someone opens something like this, now the way that the amount of volume that these dealers, especially as you approach expiration and the gamma is exploding, are become a huge contributor to where the market is trading. Like how what's your take on how big the options market is? Like a lot of people, let's say for instance, are driving Tesla higher through buying gamma, causing this feedback mechanism to occur. This has become a big dynamic in the markets. What's your take on how it's been, and do you think there's risks associated with this?
I mean, there's always risk associated with it, but first of all, I want to separate it because I think you sort of, yes, the dealers trade everything. I mean, that's what that's what we did. That's what I did for over 20 years. And you trade what's out there. But I think the risk reward and the constituencies of the traders are very different. I think the short term, you could pretty much bifurcate the market into the ultra short term. And the SIBO put out a stat. I think 51% of their proprietary products are are like trading with less than a week to go to expiration. So that's
Yeah.
pure flow. That's pure. That tends to be delta trading as much as anything else. And then of course when you have the J.P. Morgan situation, these are trades that sit for 3 months and then they reallocate them again at the end of a quarter, and everybody
Yeah.
knows these trades are coming and everybody knows they're there. One of the things that I'd like to say over the years is expiring stri- strikes with high, expiring strikes with high open interest can act either as magnets or slingshots, and it depends who's long the gamma. So in the case of the J.P. Morgan situation, um, it depends on the strike, but the call is one that they write against their portfolio, and so the street is long that strike. And when the dealer community is long, they delta hedge. So they buy low, sell high. And as you get closer and closer to expiration, that window tends to tighten and then it sort of constricts itself, all things being equal. And of course, they never are, but all things being equal, it kind of constricts itself around the expiring strike.
Right.
Unless operated on by a larger force. Like, again, if there's a pension fund out there that's buying or selling, then it's going to blow through the strike no matter what the dealers do. But the flip side is if dealers are net short a strike, um, that tends, or let me just say not the dealers, because I think the role of the dealers gets overstated on the short-term options where they're so liquid and there's so many people playing. But if the delta hedgers, if the hedgers are net short an expiring strike and it blows through there, well, you're sort of forced to do the opposite. You're sort of forced to buy high, sell low. And that's where the concept of the gamma squeeze comes in. I think in most cases, dealers are pretty well hedged. The big dealers have been around for a while. It's
They know the
I
game.
don't consider they know the game. They're not going to get out over their skis. They have bad days, but they don't. They're not structured to blow up. Could they? Sure. Will they? Pretty unlikely. I literally spent again like 25 years making sure we didn't blow up. That was like our number
That
one
was your
thing.
job.
Don't blow up. It was this buy the
Good
bid,
plan.
sell on
Good
the
plan.
offer. This stuff works pretty well, but so let's if and we're gonna have bad days, but let's just keep them manageable.
Right.
And that that's a mentality that has to be pervading the market making community. So that's why I think the problem, the one thing I think you get into with the short term options is they've really only been in the forefront during a big bull market.
Yeah.
I like to say that um, the birthday of the zero DTE contract was I think it was February 1st or 2nd, 2023, where you had a Fed meeting on Wednesday and a jobs number on Friday, and it was sometime in I think it was August or September of 22 that the SIBO filled in the SPX strikes. There was Monday, Wednesday, Friday. They filled in Thursday, Tuesday, and Thursday, but they did it during a bear market, so no one noticed. But then, as the markets had turned around by the beginning of February, um, you had this situation where a lot of people, where the Fed, that was, I think, there was a key word in that meeting. I forget what it was, but it was one of those that every time Powell said it, the market ripped higher, and people wanted to play that rally. And a lot of people sort of collectively realized, wait a minute, I can buy options that expire on Thursday that don't leave me exposed to the jobs number on Friday.
No.
And that was why I sort of call it the coming out party. But since then, we've really pretty much been exclusively in a bull market. And it's interesting. I literally just put this out today. I did the work literally this morning. So you've always heard the adage, markets take the stairs to the stairs to the roof and the
Elevator.
elevator to the basement or something
Yeah.
something along those lines. And it's actually been kind of interesting because since early 2023, the 1% up days, the big down days tend to still be bigger, although they're pretty much, there haven't been that many of them because we've been in a
Yeah.
bull market. But prior to 2023, 2022, actually, the 1% up days and the 1% down days were pretty much about the same proportion of overall up days to overall down days. I think it was like 53, something of that nature, right? Because
Right.
we do have more up days than down days. Markets go up. Um, but since then, you've had there's been a bit of an outperformance. The 1% up days are sort of like 60-40, despite it still being sort of 50, 55, 45 upward. So I think you've had this phenomenon where you've had very exuberant traders, and we saw it last Friday, chasing expiring options, particularly on Fridays when you could do it in weekly options, but I think they do it on a daily basis in your ETFs and your index options. And so I want to separate it out. I think the longer term options are still great if you're trying to do a hedge. And of course, what JP Morgan is doing it much bigger than everyone else will. But I think the short term options are trading vehicles. And as a result, they become
Yeah.
speculative vehicles, whether or not you trade them to collect premium because it's the fastest way to collect premium because you collect it and start over again. Another one of my little mantras is zero dated options are both the most expensive and the cheapest options at the same time, right? They're the
Yeah.
lowest price because there's no time premium,
Highest
but they're also
volatility.
the most expensive because whatever whatever premium you are paying is going to vanish. I'll say that with 100% certainty. Whether or
Yeah.
not it closes in the money or out of the money, that's a different story. So these are these are the features going on. So I think, for hedging strategies, it still behooves hedgers and serious traders and risk managers to be looking further out. And they're not really using the dailies except in cases of when they're a
Yeah.
little off, offsides on one way or the other. You can't really hedge that battleship. You can't really turn that battleship with daily options as liquid as they are.
All right. Well, I mean, the one dynamic though that I'm thinking is like, you have a scenario where there's new. I would say, on average, let's say once every 3 to 5 years, there's whether a Volmageddon event or a COVID style drop. There's a period where it's not even a bear market. It's a liquidity event. It's like something that creates that spill, that gamma flipping and things like that. And there's a lot of complacency in the market today that somehow the new market regime, this is not a reality and this is not really a risk. Are Do you think that with the fact that we have this much leverage being utilized through the use of options, that this could actually at some point be like gasoline on a fire when one of these negative feedback loops begins, one of these liquidity events? Inevitably, there will be one, but do you think it could exacerbate the kind of event because of the way the market dynamic is?
Really could. Although the one thing I will say is traders are much more comfortable trading from the long side than the short side, which is why I think I saw that statistic of the 1% up days tended to
Yeah,
outweigh the 1% down days, because a lot of times, there's sort of a paralysis, during
yeah,
during a sell-off. Now, the one thing that, as I think back over the last couple of years, we had a couple things that promised to be liquidity events. You had in August sort of the yen carry trade blow up. But again, I had people immediately like, "Oh my gosh, VIX is printing at 60." I literally had two text chains going on. I was actually the same text chain. Two people, and both guys. One's a very experienced option trader, and one was actually a corporate CFO. And the corporate CFO was like, "Should I be worried about this? Is my company going to be in trouble?" Meanwhile, the other guy's like, "60 VIX sold," and and it worked for him. But the problem is, and it resolved quickly because it was more of a technical matter.
yeah,
You had the savings, the Silicon Valley crisis, but that required major Fed intervention,
yeah,
and so that could have gotten pretty out of hand. You also had the Liz Truss situation in Britain, which ran the risk of getting out of hand, but the Bank of England came in. So
yeah,
you know, it, it's one of those. I think people have gotten very dependent upon the idea that every dip is a buying opportunity, which they're not always in the
yeah,
short term, but they have been, and that the Fed put, or the Bank of England put, as it were, um, comes into play. But the one thing that it's important to keep in mind is the Fed put doesn't have a strike, and it's not a
yeah,
stock market put. The Fed put is a systemic put. It's to make sure. I'm sorry. It's to make sure that the system doesn't blow up. So you have
yeah,
a banking crisis. The Fed's going to add liquidity. If the stock market just sort of organically starts to go down 5-10%, the Fed's not coming to the rescue necessarily. It's just
yeah,
not their job. It's the equities are not in their mandate until or unless it threatens the system, which is why the idea of the Fed put came in October 87, because it did threaten the system. And that's why the Fed moved in. It wasn't just because the stock market went down. It was because the stock market went down and threatened a bunch of clearing banks. And then the Fed had to step in.
yeah, yeah, yeah. Well, listen, Steve, thank you so much for the insights. But before I let you go, though, for those listeners tuning in here, where can they follow you? I know you have an X account and you write a regular piece. Please share your details.
Sure. On X, I'm at Steve Sosnick. You could follow me on LinkedIn. I'm there. And you see the IBKR behind me. If you go to IBKR campus and search for Traders Insight, look for me. You could follow my page and you could get it for free. We don't charge for our
Love it.
research,
Love your stuff.
and yeah, so I'm happy to have as many subscribers as possible. And follow it there and comment on the page and all this. We try to interact. And so, that's I would the more readers, the merrier. And
Absolutely.
you see how it goes.
Well, listen, Steve, thank you so much. You're a regular here at Huddle, and I always love to have you on. So thank you so much for joining us again, bud.
My pleasure, Patrick, and I look forward to doing it again soon. Have a good
Yeah.
one.
All right. Thank you for tuning into the Market Huddle. We'll be back next week with another episode. Cheers, everyone.